Happy Thursday. Welcome to the Brew. Today is Trader's Workshop, and we are continuing our series on the Greeks. Today, probably the loneliest Greek of them all, Rho. We're going to break it down and debate what this baby means. So let's get right to it. On the How about that music?
I forgot we had to bring our air guitars.
I know. Mark is back in the house from his trip to Paris, France. Awesome. Good to see you. You look like a Parisian, sort of. I don't know what that means exactly.
Good to be back. I'm sorry I missed Gamma. That was a fun one.
No, you missed. I think you missed Vega.
Yeah.
Oh, Vega. Sorry. Yes.
Yeah. You missed Vega. Jason and I went at it on Vega. So, Jason, looking good. Nice ultraviolet sun lamp you have on you.
No, that's not my sun lamp. I was particularly good this week, so I got a halo.
Okay, I love it. You look very bright. Awesome. All right, so let's get into it. We have just a little bit of time. Let's talk about Rho. In my opinion, Rho is probably my least favorite Greek, and technically maybe the least important, depending. And we'll get into the depending part in a second. Do you guys have any thoughts, just general thoughts on Rho before we go to the slides? Mark as a trader back in the day, was it something that you focused on?
No, and I think that's an important historical context, right? Is that from about 2007 to 2021, Rho didn't matter. Like, I mean, there were some, we saw 1% interest rates, but like there was a very long period where Rho straight up didn't matter. So no, the vast majority of my trading career, other than hard to borrow as a regular general collateral stock, Rho didn't matter.
Rho didn't matter. And Jason, what about you? Is Rho a big deal in your world?
Rho still doesn't matter.
Okay, great show. Good to see you guys. We'll see you next time, next Thursday. This is awesome. All right, I agree with all that, but Mark made a good point. So now we have interest rates sort of fluctuating a little bit, right? With inflation, and then we're thinking about bringing them down, we're moving them up, all that kind of stuff. So interest rates now all of a sudden do have a bit of an impact. However, I will say this for the retail community, much of the ones that we all serve nowadays, they being the retail trader, doesn't look too post-dated for putting their positions on. Some do, but it's I don't think it's a big thing. Most retail folks are probably 60 days and in, right? Where Rho will have its least impact. Any thoughts there? Don't all answer at once.
But even you start going out to a year with 5% interest rates, and like that's a real, like you're collaring SPX like 100 points higher. That's a difference. Like that's material. Like
sure.
Even at these interest rates levels, I would say once you start to hit 6 months or more, like you are seeing real differences there.
Yeah, no, that's absolutely true. Okay, well, let's just go through it. Let's start talking about Rho. We'll go to the slides if that's okay, and see what we have with our DALL-E 4 picture. Oh, would you look at that? All right, so Rho.
It's a guy every time, Lex.
Yeah, it's a guy. I know. That's what I don't know. They know when I type it in that I'm a dude, I guess. This ride will probably not be bumpy as we just described. So Rho's not going to be something that's going to tear your eyeballs out, most likely, right? So it's not a big deal. Very kind of staid Greek, I'd say, and one of the least important ones. Let's go to the next slide and we'll get a definition. Oh, look at that guy. He's just kind of walking in the park, very peaceful.
Is this the same guy on his day off?
Yeah, right? That's the same guy on his day off. You're exactly right. That's good. I didn't think about that. So Rho is a measure of the option sensitivity to changes in the risk-free interest rate. Okay, and risk-free, I just put U.S. Treasury bills. That's pretty risk-free. And it's always compared, they always measure it for a 1% change in these interest rates, how much it will affect the option price. Now, I don't have in here, but we were talking about it pre-show. Calls are positive Rho values and puts are negative Rho values. So if you raise interest rates, calls are going to go up, puts are going to go down. We're going to see an example of this at the end in an explanation of synthetics, which is going to be mind-numbing. But anyway, go. Sorry, Mark.
I totally agree with this definition here. Because Rho doesn't matter, it doesn't even matter what this definition is here. But the risk-free interest rate, like, I think that's a good way to think about it. I think is like a very inside baseball practical thing. It's more reflective of the clearing rate of large market participants. That like it's more closely modeled to like the cost of capital for like large institutional participants, whether they're dealers or whether they're other market players, right? That it's which is slightly different than the T-bill rate.
Yeah.
I'm on mute. Sorry. Go ahead, Jason. You were going to say something?
No, I was just going to take your spot because you were dealing with your dog.
Yeah, we have dog issues.
No, he's right. I mean, it's just, and you know, the value of Rho. You know, you guys are going to talk about cost of capital and stuff like that. To me, it basically means how much annually or quarterly, even or whatever, you can sell a call for. You know, your collar can cover your puts a lot higher when you sell your call. So I mean, so for me, that's what the meaning of it is.
Yep. Okay. Fair.
And you could So yeah, go ahead. You guys can.
No, that's fair. I mean, I think Mark and I are going to debate it out, this interest rate thing relative to the dynamics of it and what it really means. You know, parity versus extrinsic value. We'll see that in a second. Let's go to the next slide. So we're in agreement with that one, I think, right? Now here's a little graphic, and if you guys look at, I know you guys haven't seen this, but the lighter colored line, or I don't know what color that is, oranges, is call row, and the put row is the one beneath it. Now, the thing to take away here is if you see the underlying stock price, which would be the at the money strike at the 100 level here, you can see that these to the left of the, can you see my mouse on here? I don't know if you can or not, but the to the left here on the call one, that's indicating where Rho's highest. Okay, where Rho's highest for deeper in the money calls, and we'll knock this out in a second. And it's not as important for those out of the money puts. Conversely, you can see the negative Rho values on the deeper in the money puts to the right of the curve, and less important on the out of the money calls, corresponding out of the money calls. Anything to say about this, guys? Don't all answer at once. No. Anyone? Bueller?
I mean, the one thing I'll point out is the space between the calls and the puts are always the same. And that's like the total kind of like aggregate Rho.
Okay.
You know, like even at any strike,
sure.
That's, you know, it's just kind of redistributing the interest rate on whatever type of whatever kind of option you have.
Right. Okay, good. All right.
An interesting intuition is that, like, if you think of, you know, I know you like this analogy, Lex, about like the, you know, amount of interest you might get on your short stock or pay on your long stock, that like it's going to be reflective of the delta. So a deep delta put is going to have a lot of Rho because you're going to need a lot to hedge that. Same with a deep delta call.
Right. That's good. I like that. Okay, let's go to the next slide. This is a weird little slide. This is just, we're gonna pass by this in a quick second. So we're just talking about extrinsic and intrinsic value. So intrinsic value, I like to refer to it as parity. It's the difference. It's an in the money call. It's the difference between where the stock is trading and the strike price, right? That's parity. Okay. And Mark and I are going to debate whether that changes or not. And for a put, it's the strike price minus the stock price. It's opposite because puts are in the money when the strike is higher. And that's all this is defining. So, and we're going to debate whether intrinsic or extrinsic value is changing here when Rho changes. So let's go to the next slide. Okay. Oh, that's scary. So we talked about this earlier. Rho's probably not terrifying. We might have had a few terrifying moments when we went from 0% interest rates under this inflation scheme to, where are we now, guys? About 5%? Is that somewhere in the ballpark? Interest rates. So that was a pretty, you know, steep increase in interest rates, but it's not the kind of thing that happens instantaneously, right? Interest rates kind of sit around for a while, and then they make a decision, they raise them or lower them. So it's not a terrifying big drop, or, you know, in scariness all of a sudden. Would you guys agree?
Yeah.
For most intents and purposes.
Yes.
Right?
For most intents and purposes.
The edge cases, it's the hard to borrows of the world where interest rates 0 to 5 isn't scary, you know, 0 to -50 is scary.
Yeah, and we'll talk about that in a second. That's a good point. All right, let's go to the next slide. So it's not terrifying. It's generally delightful. You know, are you really hedging for Rho risk in the retail world? My feeling is probably not. Not a big deal. This is Mark in Paris on a beach somewhere in, up north somehow. Enjoying
I would,
sure.
Yeah,
right.
it's nice, but I wouldn't even say delightful is the right word because we ignore it. So, I mean, delightful means like I'm making money and I don't have any risk, but I'm not making money either. So.
It's like I'm not even thinking about it. So it's nor delightful nor nothing, right?
Right.
All right.
Which is, I mean, you could like think about what a box spread does to like borrow or lend money from the options market. Like you could just be sitting there safe and sound collecting your T-bill or, prevailing interest rate level of, coupon because of Rho.
Right. That's right. That's true. Good point. Go ahead. Sorry, Mark, Jason.
Yeah, you're not still. I mean, like you could just buy a bond and get the same.
Sure,
same
that's true.
You might not get that if you're just a bond investor.
Let's go. Next slide. It's going to get more complicated here in a second. Okay. All right. Here's some of the details.
Keep promising this, Lex.
I promise. I know where the slides are. So it's things that affect Rho. Time to expiration. Farther dated options are going to be more sensitive to changes in interest rates, right? Just more time to carry stuff, more time to have it or pay for it, as the case may be. So that's number one. Higher stock prices. Rho affects those. Why? You're paying on a higher value, or you're receiving on a higher value. So those bigger stock prices are going to matter. Calls, as we talked about, generally rise with interest. When interest rates rise, puts generally decrease in value. We're going to see an example in a second. Mark and I are going to argue about it. And incidentally, we said before, Rho for calls is a positive number. Rho for puts is a negative number. So by definition, then interest rates go up. That means since a negative puts are going to go down, calls are going to go up. Okay. And we already talked about moneyness. In the money options, where there are calls or puts, will be more affected by Rho changes or changes in interest rates, which is the Rho component here. Any comments here, guys? No.
Nope.
No one likes Rho. This is like everyone's asleep in the class. No one likes this topic. But we had to cover it. So here, we'll get through it. Don't worry. All right, let's go to the next slide. Here's where it gets. I think where it gets in. Oh my God, would you look at this? All right, here's the deal. So let's look. Let's try to see how this actually works in practice. And Mark, you hash it out with me here. My example on the left: call price is $5, put price is $5, stock price is 100, strike price is 100, cost to carry is 0. So the way I looked at this in the old days on the floor, we had synthetics. A synthetic is buying a call, selling a put, same strike, same expiration, or the reverse. Okay. If you buy the call, you're long the synthetic. That is synthetic long stock, right? So I'm buying the 100 strike call, selling the 100 strike put. That is synthetic long stock. The way we would hedge that, oh God, I'm doing one of those things. The way we would hedge that is sell the stock against it. Now, if that relationship was out of line, we would make money or lose money, as the case may be. So in this example, if we did this right at these prices, we make 0 money. Agreed? Except you're going to lose your transaction costs. We're not going to talk about that right now. Safe to say, right, Mark? Jason, you're on board with this? Okay.
Yep.
So the way we measure that synthetic is we take the call price minus the put price up in the top right, which in this case is 0, add it to the strike price, which is 100. 100 plus 0 is 100. Okay. We compare that to the stock price. So in this case, it's 100. Everything lines up, right? Questions, comments? We good? Next slide. Next slide. Here's where it gets a little tricky. Okay. Now let's pretend interest rates go from 0 to 2%. And I made up these numbers. This isn't exactly what happens. I just made them up for illustrative purposes. So when we make interest rates go higher, now the cost to carry this stock goes up. You have to pay interest on long stock, or you're going to receive interest on short stock, right? And we're going to receive, and I just made it 50 cents. Just say you either paying for it or you're receiving it. In this case, we're going to say we're going to be short the stock, we're going to receive it. So now that this happens, that $100 parity is a little different. That synthetic versus the actual is a little different. Why? The stock price hasn't changed. It's still $100, but I'm getting 50 cents for shorting that stock through the term. And if I'm getting 50 cents in my bank because interest rates are higher, I can pay to make the synthetic, even again, 50 cents more, right? Because if I pay 50 cents over where the stock price is, I'm going to get that 50 cents back in the carry because interest rates are higher. It's going to bring me back down to that parity number. That's what all this gobbledygook says. So what happens is that the call and the put have to affect that 50 cents. So if the call's going up and the put's going down, and I just made it uniform, not necessarily this, but I made the call go to 525 now and the put go to 475. The difference between those 525 minus 475 is now 50 cents debit. Add that to the strike. That's going to be 100.50 with the stock still trading 100, but I'm getting 50 cents to make it go back down to that parity number. Now, Mark, tell me about your thought here on forward pricing relative to deeper options. Does this all make sense, by the way, guys? And clarify if I didn't make it clear enough.
For sure, and I'm going to throw out some terms additionally to help frame this: a combo and a reversal and a conversion.
Okay, perfect.
And so a combo is where you buy the call and sell the put, or sell the call and buy the put to create a stock-like, position, equity-like position, 100 delta, long or short. The difference between that combo price and the current price of the stock, the live price of the underlying, is your cost of carry. And that, divided by the value or the stock price is your interest rate over the amount of time.
That's
so
right.
Like that price in RevCon terms, reversal conversion terms, is the dollar price, like in nickels, dimes, quarters, dollars, of what the value of carry for that period is.
Mm-hmm.
So that parity is always enforced because the cost of carry is, part of the model. So the difference in those call and put prices, as defined by that RevCon combo versus stock, is a dollar and cents value of what the interest rate is saying.
That's right. So that's perfect. Now go back to the 100 delta option. Okay, let's take a call first. So what's technically happened if you buy a 100 delta option and you sell 100 shares? Okay. Oh my God, this stupid thing. How do I turn that off? My God. I hate that. How does someone tell me how to turn that off?
It only happens to you too.
I know.
We need
I can't use my thumbs anymore. So what's going on there? If I have a call that I'm long, okay, and I have shares against, I'm going to want to collect the short interest when interest rates go up and not exercise my call, right? There's an incentive for me not to exercise with higher interest rates to carry long stock for longer periods of time. Agreed? Mm-hmm. So what does it do to the price of the call? Now, the stock hasn't changed and, parity really hasn't changed, but something has to happen to that call. You're able to pay a little bit more over parity for a 100 delta call because you're going to get, if you're selling stock, you're going to get that interest rate. That's a bigger number, right? On the put side, it's different because you're going to be incented to exercise the put early because of the interest rate component, to get short stock. So if you're long put and you're long stock, right, you're going to say, why would I carry the stock when interest rates go higher? I can exercise this put right now and take me out of that and collect that extra 50 cents now, right? So puts become exercisable. Sorry?
Or at least not pay it.
Or at least not pay. That's right.
And exactly, like you went to the put side, I was going to go negative with interest rates on the call side and say that your call price will never drop below true parity in this case because you can just buy the call, punch it, sell the stock.
That's right. Yep, exactly right.
And no matter how negative rate you're paying on, at the monies or puts or whatever, that call will always, be worth as much as the stock price because of in an American option scenario.
That's right. That's right. Yeah, and quite frankly, the puts, you might see them trade under parity a little bit, right? Because I'm gonna exercise those babies, and depending on what the interest rate carry is, they could trade a little bit under parity as well. So it might
don't want short stock.
What's that?
Because you don't want to pay for that short stock if you're in that negative rate scenario.
That's right. That's right. So it's an interesting dynamic to understand what happens. Now, again, practically, I think for most retail traders, this is not an issue. They're not doing conversion reversals in leaps at all. Okay, but our point here is just to explain what all this stuff means, and just so people get a good understanding of why these things happen with prices when with all the Greeks. So that would be my point. We'll talk a little. Let's go back to the negative interest rates for a second. But Jason, do you have something to say?
Not really. I mean, again, this is not like the determining factor for most retail traders.
Yeah.
But I will say that Rho, I think, because of the costs of calls going up. I mean, in Volland, we've been seeing a lot of call selling and not a lot of put buying. And I think that a lot of that is because of these Rho interest rates. I mean, people would rather not pay the carry that we're seeing now, which is pretty high. It's higher than it was.
Right.
So I think that when you're talking about, and from a practical standpoint, that's one of the drivers, I think, of a lot of the activity that we're seeing.
Right. That's right. Yeah, and I think and that's another reason why when you look out in time, and you have a positive interest rate, that the call and put aren't the same value on the 50 at the money line. Assuming that the stock's exactly at the price, right? Because of this interest rate component, the call and put have to be a little bit different. Okay, so that you can account for this interest rate component. Otherwise, you're going to get nailed. And probably a lot of retail folks don't think about the interest rate component here. We as traders on the floor, we dealt with a lot of these conversions, reversals, boxes, all this sort of thing. We had to manage our interest rate exposure, right? Because we truly got charged on, for long stock, and we collected on short stock. So, there were some savvy people who traded interest rate sort of plays. And if you didn't understand what you were doing, you could get burned. It happened to me once. I made a mistake on a calculation, and it cost me a lot of money. To the point where I came into the clearing firm on my hands and knees and begged to get me out of it. And thankfully they did. But there was a valuable lesson that I said, ooh, interest rates matter for us. So,
and as much as I agree with Jason, like the vast majority of times, especially where people are trading, especially where the activity is, this doesn't really matter. But with 5% interest rates, there are more places that matters, and it opens up like different trading opportunities, right? Like if you're ever using a collar, like it's going to matter. Long dated collars absolutely matters. The structured products you can create with positive interest rates right now, like there's meaningful call premium you can buy, like with zero coupon bond now because of high Rho and high interest rates now. So while most trading strategies don't incorporate it, because they're high, there are new ones that are interesting.
Yep, I agree. Okay, I think that's all I got on this one. We spent a lot of time on something that's not super important, but why not? I think what we should do, though, going forward in subsequent ones is let's continue the conversation, but let's move to sub second order Greeks, the things that Jason likes to talk about with Volland, if that's okay. So I would say we'll look at Vana, Charm, Vama. Is that important to you, Jason?
It's more important than Rho.
Oh, good point. Ooh, God, poor Rho, man.
Rho hater up here.
We've got a Rho hater. Okay.
A lot of times,
I feel obligated to defend
directional trades, and Rho stays the same for the duration.
Yeah,
of that, so.
I know. So can we knock down Vana, Charm, and Vama in one episode, or do we want to take them each?
Oh, no, I would take them separate.
Okay, let's do it. All right, so we'll start that series going forward. What else? Couple announcements before we go. Don't forget to sign up for the summit. Register for the summit. It's May 22nd, which is a Wednesday. It's a week from yesterday, 10 a.m. Central. We're starting. You should see mailers on it. You can go to hub.tradier.com to sign up, or you can go to tradier.com to sign up. And make sure you're going to be there. It's going to be a great 7-hour day of a lot of people presenting, and we have an interesting panel to go to or to view during the show. And I think that's it on Summit. What else, guys? Mark from harvestedfinancial.com, Jason from volland.com. I might have said that.
No, vol.land.
Vol.land. Who does that? Vol.land.
You do.
Okay, you do. So check him out. And Mark, when you read his blog, sign up for it. He's got the coolest dolly images all the time, too.
It's till.substack.com.
Yep. Don't forget to go to hub.tradier.com too. Sign up. Anything else, boys, before we head out? All right. Rho, put us all to sleep. Gosh darn it. But I'm happy now we got through that. I hate talking about Rho. No fun.
Let's see how many comments people left about Rho.
Yeah, exactly. 0.
Crickets.
Crickets on Rho. Who cares? Now they know what it is. Good dinner party, cocktail party kind of conversation. All right, guys. Have a great rest of the week. See you next week.
Happy trading.
Right.
Happy trading. Calling all options and futures traders. The markets may be wild, but you don't have to be. Join the Tradier Options Summit sponsored by SIBO on May 22nd. Let's tame the volatility with expert tips and strategies on navigating volatile markets in 2024. I will be hosting this full-day virtual online event. Learn from the best. Industry leaders will share their insights, trade ideas, and strategies on navigating these volatile times. Plus, get a sneak peek into Tradier Futures, which will be launching soon. Sign up now to be part of the action. Reserve your free spot by registering at the link below. If you're part of our email list, stay tuned for your invitation and link to register. Also, remember to visit hub.tradier.com. Join the Tradier Hub for free for all your market insights, trading ideas, market news, and daily live shows with industry experts covering all aspects of the financial world. See you on the 22nd at 10 a.m. Eastern Time, sharp.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.